Yes, we think now is an interesting time in the market to be deploying funds. There's been a lot of disruption this year because of the COVID-19 crisis, which means that valuations have got a bit inefficient just recently. And that always presents opportunities for small cap fund managers. So we're excited about the next 12, 18 months in the market or so. AIM has matured incredibly over the last decade as well. I mean, when we first launched our AIM Inheritance Tax Service, there were probably only a pool of about 100 companies that were dividend-paying, profitable, progressive growth businesses, and that pool of businesses has grown to probably 400 or 500 now. So there's a much wider selection of exciting investment opportunities to choose from. Than perhaps there were 5 or 10 years ago. It is, I mean, when it comes to timing as well, people need to remember this is a long-term investment. You know, we're investing with a 3, 5, often 10-year time horizon. And so people need to perhaps relax a little bit about the exact entry point, but realize you're getting a portfolio of progressive growing companies that we hope will be significantly larger businesses in the next 5 or 10 years. So it's really about just getting on that journey, getting that journey started.
So if you look at the index over its life, which is about 20 odd years, that it's not been the best index to actually invest in as a whole. But what we find is if you're a stock picker and you're prepared to get under the bonnet of some of these companies, that it's a fantastic hunting ground. So I believe at the moment, especially in these sort of COVID times, there are companies that have been overlooked and therefore a really good time for investing.
Yeah, in lots of ways, it is a really good time to invest in AIM. We've had a market correction, obviously, through a very, very, very difficult period. COVID sorts the wheat from the chaff, I think. We were overdue, probably. And therefore, as a result, there's been a lot of repositioning. And one's had to look at it very, very carefully. But certainly, when you do look at it now, there's better value around. Companies are starting to exceed what were much reduced expectations, which is good. And the main thing, I suppose, is what's the risks from here? They're a little bit unknown, but probably the two big ones for us would be weak management and certainly the inability to adapt to what is very much a new environment. No one quite knows how this COVID is going to pan out exactly. Obviously, the news has been much better. A vaccine is good news, but we've still got some way to go. At the end of the day, we're going to have to get through Christmas and see what happens early in the new year. So you've got COVID as one of the things that they've got to watch out for. And then, of course, slap bang in the middle of everything, which almost everyone's forgotten, right at the end of this year, of course, we fall out of Europe. So it is a little bit buyer beware and be very, very selective. But in general terms, we'd say there's good value around.
So AIM as a market looks in really good shape and it's never been healthier. There are a lot of really good businesses growing strongly, and that's been the key attraction of AIM, growth over the main market, and why it's been outperforming the main market over a number of years. However, a lot of these growth companies, a lot of the bigger ones, are now priced to perfection, means their valuations are very, very high and look very, very stretched. It should be remembered that a lot of these aren't super high quality businesses. They're not generating the sort of returns that justify super high quality ratings. And this is compared to their, for example, US peers, which are growing even stronger. Selection is becoming trickier, and it's now become a lot harder to decide whether to maybe stick with some of these growth companies that perform very, very well, or to look lower down AIM into the smaller companies, some companies who had suffered, who look perhaps have better valuation attractions. However, the big risk here is some of these seemingly modestly valued businesses, smaller ones, are going to stay modestly valued businesses because their growth is constrained. And that is a real risk. These are so-called value traps. People get trapped into stocks that look, good value, inherently good value, but remain good value, and share prices really, really languish. So AIM's in great shape. However, selection is probably the hardest we've seen it. What we could do with is some new entrants. So we'd like to see new entrants, and we're starting to see those come through. Clearly, this was difficult over the pandemic, but we're really encouraged by some of the newcomers, the recent newcomers to AIM, where valuations are a bit more modest, albeit they're untested on AIM, but they're still well-established businesses, and they look, some of them look quite compelling.
Certain pockets of AIM, certainly, particularly 200 million market cap and below, and the top decile is trading now on a PE of 40 times. So yes, AIM, but you've got to be even more selective than normal. And as you go down the market cap spectrum, we're not talking nano or micro cap, 200 mil, 150 mil, you can pick these things up on 20 times or less even. And we feel actually the growth prospects for these companies are much, much stronger actually than the current AIM darlings. We're looking for tomorrow's winners, not yesterday's.
I think there's three good reasons for sort of long-term investments in the AIM, and I'm not saying that this is always the best time to invest in AIM, or it's the best time to invest in any market. What I'm saying is that these are good reasons to put money away for the long term. The first of all is that the AIM market is home to a number of interesting growth companies, and I don't just mean the exciting high growth ones that we're aware of, like the likes of ASOS and Boohoo and stuff, but just sort of some very solid, sensible, cash generative businesses that will continue to grow over the next 5 to 10 years. The second reason to do it is because of family businesses. There's some really interesting companies down on the AIM market that have gone down there for business relief and are actually very good quality family businesses that have been around for decades, that are delivering good long-term growth, they're delivering good cash flows, and they're the kind of sensible, solid businesses that investors should own. And as part of that, the third real reason is business relief, which is obviously, in addition to delivering investment returns by investing in AIM, you can actually benefit from inheritance tax mitigation by investing in AIM, as long as the stocks that you acquire qualify for business relief.
AIM has come out of the pandemic relatively well. It's actually up on the year and has greatly outperformed the larger peers such as the FTSE 100 and FTSE 250. AIM is home to smaller, more agile companies that actually in this crisis have proved their ability to adapt to lockdown. The index has got good exposure to technology and growing healthcare companies, and they have proved strong this year, and we actually expect that to continue going forward as well. We expect to see strong economic growth in 2021, and because AIM is home to typically smaller growing companies, then actually we believe it is a good place to be going forward.